Good morning, traders. This is the first video kind of in the series of investing. Today we're going to talk about stocks. Stocks price can go up with economy, and the price can go down when the economy is doing bad as well. So, you can pick up, listen to the news and see if the economy is going good. Companies are hiring. When they do, they tend to make more money, and the price of stock tends to go up as it follows earnings. That has a big impact on the price of stocks. So, when the economy is going good, it's good to be long stocks, generally speaking. And when the economy is going bad, it's generally good to be short stocks because companies are not making as much money, and their stock price tends to reflect that by going down. Stay ahead of inflation. Inflation is something that's always around. Some years it's worse than others. But if you don't stay ahead of inflation, you're losing buying power. For example, if you put $1,000, say, in the bank right now, and you might get a 0.5% of interest for a year, at the end of the year, you go back and the bank will give you $1,005, give you $5 for interest. Well, if the price of inflation went up by 5%, that means that $1,000 eroded $50 worth of purchasing power. So you gained $5 at the bank, but you lost $50 out in the world where you buy gasoline and food and whatever you purchase. So you're not keeping up. You're actually you say, well, hey, I made $5 per 1,000, but you're actually losing money based on inflation. So stocks has always been one way to hedge against inflation. Another one, they're easy to buy and sell. It used to be when I started this game, you'd have to go to a brokerage house or you'd have to call them on the phone and, say, hey, buy me this or buy me that. And it was very cumbersome and it was really expensive. I can remember buying 100 shares and paying like $20 or $25 in commissions. Well, today, you can buy a lot of brokerage outfits are offering, free commissions, but you need to really look into those. How do they offer it free? I tend to believe that they do this by not giving you as good as bid and ask price as they were at the places where you pay. And in some places, you pay just $1 for a transaction. In other words, you buy 100 shares or 10,000 shares, it's just $1. And, if you're buying, just say 100 shares, and you get a 2 cent per share better price, you're giving the brokerage house $1, but they're saving you $2, so you're actually $1 ahead. So that's just something to think about. I know in the world of everybody likes everything for free, apps on your cell phone and free computer programs for your computer, and they like free commissions for stock. But somehow, some way, the brokerage company has to make $1, otherwise they can't stay in business. So you might really want to consider looking into the true cost of operating a free brokerage house. Okay, let's talk about some of the bad things about stock. You risk losing it all. You can buy a stock, any stock, and theoretically they could go bankrupt. They could go out of business. Now, if you buy something, some of these big companies, big car companies, you buy General Motors, you buy Ford. They've been around a long time. Chances are they're not going out. You buy Apple, pretty good chance it's not going out. Those type of names, but a lot of people, they try to deal with these stocks that are $2 and $5, and I do a few of them myself. They're around $10 or $15, but they're 10 or 15 or $2 for a reason. Okay, think of it that way. So possibility of a company going bankrupt, it happens. It happened to me. One of the first stocks I ever bought was Commodore Computers, and they're no longer around. So I didn't ride it all the way to bankruptcy. I got out after a sizable loss on my first day of owning it. So just be prepared to know that you could lose it all. It takes time to research. I guess you can sit back and throw darts at a dartboard and say, I'm going to buy this or that stock. But if you're going to make a sound investment, an educated investment, it takes time to research it. Okay. And stocks are large capital requirements. Now, what do I mean by that? For example, Apple is around $150 a share right now. So you're going to have to put out $15,000 just to buy 100 shares. Or if you're on a margin account, you have to put out half of that. You'd have to put out 7,500 to buy 100 shares. But then you're going to pay interest to the brokerage house to loan you the other $7,500. In theory, on a margin account, that's what you're doing. You're putting up 50% of your purchase and borrowing the other 50%. And borrowing comes at a cost. You have to pay them interest. So if you were to buy the stock and have to hang on to it for, say, 6 months or a year, and you say, well, and sell it and say, man, I'm at $1 a share, I made $100, but then you may have paid, I don't know, $50 in interest, you really didn't make that much money. So that's something to consider. And of all the investment vehicles of stocks, options, and futures and future options, stocks is the least leveraged and the most capital intensive investment there is out there. So, you want to, in my opinion, when you invest, you want to gain some leverage. If you're taking a dollar, investing a dollar, and having to put up that dollar versus and getting 1-for-1 action versus maybe putting up a dollar and getting 10-for-1 action, um, you know, you can have a very good opportunity to make a lot larger return. So that's kind of it for this video, and hope you give you some food for thought, and good luck to you out there.